Alright, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. And while that may sound like a mouthful, words matter, and there's a reason why I use those specific terms. If you've been searching the internet looking for information on life insurance and real estate investing, you'll come across a lot of different sites that show you how you can do it. But there's doing it, and then there's doing it right. So today's video is about the three critical or key success factors for the double play. Obviously, the double play and other private banking strategies work. There are thousands of people out there leveraging policies every day to invest in real estate and other things. What I want to do in this video is show you how to do it right. Little things like making sure that your policy is designed properly, how you access the cash value, the type of policy that you use. Those things are all important and make a big difference that'll pay off down the road. So I'm not going to cover a lot of the life insurance fundamentals in this video. I'm going to dive right into it. So if you don't have a good grasp of the double play fundamentals or even how permanent life insurance works, I've got links to videos in the description that I think of as a prerequisite for this. But if you've seen those videos and you've got a pretty good understanding of the double play and you want to know how to do it best, then stick around and I'll get started right after the intro. I'm Tom Rutkowski with Innovative Retirement Strategies, and I came up with the concept of the double play on my own many years ago. And it's so powerful that I wanted to share it with everyone. So that's why I created this channel. And the goal of this channel is to explain how the double play works and give you the tools that you need without ever talking to an agent to get the most efficiently designed policy possible to maximize your wealth accumulation through your use of the double play. And along the way, in the process of understanding how life insurance truly works, we're going to debunk a lot of the life insurance myths. And in fact, you'll probably debunk a lot of those myths yourself, just having an understanding of how life insurance really works. So today's topic is the three key success factors for the double play. And I've covered each of these separately in previous videos that I've done. After I did the introduction to the double play, we've talked about various factors that are important. In this one, I want to just pull everything together into one video and put it under one roof so that you've got access to what I think of as the most important factors to do this right. Again, there's doing it and there's doing it right. And if you want to get the most out of your little financial engine, you want to make sure that it's firing on all cylinders. All right, so let's take care of some formalities. Nothing in this presentation constitutes financial or tax advice. And the primary reason for purchasing life insurance is for the death benefit protection. Any other benefit is ancillary. All right, so what are the three key success factors for the double play? Well, the first is you have to use a maximum overfunded life insurance policy design. You want to keep the expenses to an absolute minimum so that you can get the most cash value. Secondly, you want to access the cash value in the most tax advantaged manner possible, and that means utilizing a cash value line of credit. And lastly, you want to choose the policy type, index universal life or whole life, that will give your cash value the best opportunity for growth. So let's start with key success factor number one, utilizing a maximum overfunded life insurance policy. So I want to break this up into two subsections. First, I want to show you how you can recognize that the illustration that you're looking at is maximum overfunded life insurance policy design. And then secondly, I want to show you why it's so important by looking at a numerical example. So if you've got a life insurance illustration in your hands or you're getting one from an agent, the way that you know that your policy is designed properly is simply to look at the first row of the illustration and look at the ratio of the cash value at the end of the year to the premium that you paid into the policy. That ratio should be about 85%. And it's important to keep in mind too that on the illustration, the end of year cash value is factoring in the dividend or interest crediting that you would have received in that first year. So oftentimes you'll see a number like here that's actually much better or higher than 85%. But if you back out the 6% that I've assumed in this illustration, for example, and then do the math on that, you'll find that it is pretty close to 85%. So let's take a look at a financial example that illustrates the difference between a policy that's not optimally designed and one that is. And a lot of the overfunded, highly marketed whole life policies that you see out there, where the paid up additions are intended to be used to build up your bank over time, those policies are not maximum overfunded from the beginning. And oftentimes they have about 65% cash value to premium, with the understanding that later on you'll pay paid up additions into the policy to get the cash values up. But if you're leveraging the cash value to invest in real estate, you want to have as much cash value that you can have on day one, because you're putting your money to work in two places at one time. So if we look at this graph here, in the suboptimal policy, we're starting with $100,000 of premium, and after the fees and expenses of the policy are paid, we're left with cash value of $65,000. For this example, I'm assuming that the dividend is 6% per year. So just from the life insurance perspective, this policy is going to have a $3,900 dividend at the end of the year. All right, so if we assume that this client is accessing the policy's cash value with a cash value line of credit, then they've got $65,000 that they're putting into a hypothetical investment paying 10% per year. So at the end of the year, they end up with a gain of $6,500, or interest income, or however the investment pays. If the interest is tax deductible and the interest rate on the loan is 5%, we're going to write a check to the bank for $3,250, which leaves taxable income of $3,250. In the 40% tax bracket, that client is going to be writing a check to the IRS for $1,300, leaving a total profit on our side fund. I'm calling it side fund because it's outside the life insurance policy. A profit of $1,950. So if we take that $1,950 and we add it to the $3,900 that we made on the cash value, we have a total gain of $5,850. So that all sounds great. And if you were looking at this without actually looking at the numbers, that might sound like an awesome return. But let's just keep in mind where we would have been had we just taken our money directly and invested in that hypothetical investment. So I didn't put this into a slide, but the math is very simple. You would have taken $100,000, earned 10% on it. So you've got $10,000 at the end of the year. In a 40% tax bracket, you're going to write a check to the IRS for $4,000, leaving you with $6,000. So which would you rather have, $6,000 or $5,850? So here you can see that because you're not utilizing as much of the cash value as you could in a properly designed policy, you're not even doing as well as you could have had you invested in the asset directly. Now, if you need life insurance and you need the death benefit protection, there's a lot of benefit to this, right? You can do two things at one time. But if you don't need the death benefit protection as much and you want to get the most bang for your buck for your dollars, we've got to do it in an optimal fashion. So on the right side, under the optimal column heading, we're taking the same $100,000, but this time in an efficiently designed policy, after all of the fees and expenses are paid, we're left with $85,000 of cash value. If we assume it's earning the same 6% dividend that we had in the other example, we're earning an interest crediting or dividend of $5,100. Now, that's just the life insurance alone. So we've done that much better just by having a well-designed policy. Now, if we leverage the cash value, We're going to have a loan for $85,000 that we're investing in that same hypothetical investment, making 10% per year. So at the end of the year, we'll have gross income of $8,500. If the interest is 5%, we're going to write a check to the bank for $4,250, leaving us with taxable income of $4,250. And from that taxable income, we'll write a check to the IRS for $1,700, and that'll leave us with a profit on the side fund of $2,550. So if we add that $2,550 to the $5,100 dividend or interest crediting that we received, we've got a total gain of $7,650. Now, it's important to understand that while we have $7,650 there, we're still not back to even. What we did was we turned $100,000 into $85,000, and then we grew that at a faster rate than we would have. If you remember, in the status quo example of just taking your money and investing it directly in real estate, we had a net after-tax return of 6%. So we're doing better. And really the question now becomes, would you rather have all of your money growing at 6% or 85% of your money growing at over 7%? And if you understand the power of compounding interest and time, you would much rather have the latter. And that's why we're here. So on this graph, I'm illustrating the difference between the two different scenarios. The red line sloping, the green line shows the $100,000 investment that we've got. So if we use the optimally designed policy, that's the red line, we're starting off with less, $85,000, but we're growing at a faster rate of return. So we will ultimately catch up to our original investment, the green line. It looks like about a little more than 2 years out in the future. However, when you use the suboptimally designed policy, it's going to take all the way out to about year 6 before your $65,000 earns enough by working in 2 places at one time to catch up. Now, mind you, this graph doesn't use the same assumptions as the previous one. I was using a 7% growth assumption here. So the poorly designed policy actually did achieve a higher rate of return than investing directly in real estate. But you can see that it just takes that much longer to get back to your original investment. But the original investment doesn't really matter, does it? Because if you would have taken that $100,000 and invested it in our hypothetical investment, you would have ended the first year with $106,000. So you've got to catch up to not only the money that you've got into it, but where you would have been had you done the alternative. And that's what the double play model is really all about. So in this next graph, I'm actually comparing the results over time, utilizing the yellow line here represents the real estate alone option. So clearly in the first years, you can see that it's actually outperforming the other 2 scenarios. But over time, because the other ones are actually achieving a higher rate of growth, they are beginning to catch up to and then finally surpass the real estate alone option. But the difference between the 2 scenarios, of course, is obvious. Over time, having more money going to work for you is going to result in greater wealth accumulation over time. All right, key success factor number 2 is accessing the cash value in the most efficiently way possible. And that really comes down to utilizing a cash value line of credit so that the interest is tax deductible as a business expense. So what I want to do in this section is just compare using a tax deductible interest versus not using tax deductible interest. And we're going to start with the same exact assumption that we had in the last example. All right, so on the left side of this is the same exact business model that we looked at a second ago for the policy design section. But on the right side, I'm moving things around a little bit and showing you what it looks like if we don't have tax deductible interest. So here at the top, $100,000 of premium turns into $85,000 of cash value. If we're assuming that it's earning a 6% dividend, we're ending up with the same $5,100 dividend at the end of the year. We're still borrowing the same amount of money, $85,000, putting it into the same investment, earning 10%. So we finish up the year with $8,500. But here's where it gets different. Because the interest is not tax deductible, you've got to pay tax on that entire $8,500 gain. So at the 40% tax bracket, you're going to be writing a check to the IRS for $3,400. That leaves an after-tax income of $5,100. Now we have to pay back the bank. So at 5% on $85,000, that's $4,250 that we're writing a check to the bank. And that leaves us with a net profit of $850. So $850, if we compare that to the $2,550, it's 1/3. You're performing that much more poorly by not utilizing the tax deductibility of the interest. And again, if we look at our final result, we're finishing up the year with a gain of $5,950. Had we just invested in real estate directly without going through the effort of buying a life insurance policy and leveraging the cash value, we would have made $6,000. So here again, clearly, you can do it, and you may even think that you're doing better, but unless you look at the numbers and analyze it, this example is not better off. Now, had you made a better return, or maybe you were in a lower tax bracket, maybe this would have worked out for you. But clearly, you can see that on the left side, where we're utilizing a well-designed policy and we're getting the advantage of the tax deduction, we're finishing up the year with an improvement over what we would have done had we just invested in our hypothetical investment. And finally, we come to key success factor number 3, utilizing the right type of policy to ensure that your cash value has the best opportunity for growth. And frankly, that means utilizing an indexed universal life. And I understand that I'm going against the grain because most of the sites that you'll find as you're doing your research are dedicated towards whole life. But they talk about fluffy things like guarantees and paid up additions and things that really don't matter in a life insurance policy. This graph that I have on the screen right now, it shows you what a maximum overfunded policy design looks like. In this case here, the client is putting in a $100,000 premium for each year for 10 years. And we're solving the policy to get the lowest possible death benefit during that time. So the orange line represents the death benefit. The blue line represents the cash value. And in those early years, you can't see it, but there would have been about $85,000 of that initial $100,000 going right straight to the cash value. But you can see that death benefit protection, there's a cost to that. And over time, as you get older, the cost of insurance goes up. So once the client is done putting premium in after 10 years, we need to make a change to the policy and lower the death benefit to drive the cost out of the policy. And you see that in the orange line here, because at year 10 it drops, and what we're doing is maintaining the minimum amount of life insurance death benefit protection possible given the amount of cash value that we have. So this is an efficiently designed policy. And frankly, it looks like this whether it's a whole life or an indexed universal life. In the case of a whole life, we get that higher death benefit by bundling a renewable term rider with the base policy that we use. Well, you have to take that term rider off once you've got your cash into the policy. Otherwise, the cost of insurance will continue to consume cash value in the policy. So once the death benefit is reduced, and we're maintaining as little bit of death benefit protection over the cash value as we can get, it really comes down to what the cash value is going to earn. And in this graph, I've got a little arrow in there. So what the arrow is representing is if the cash value can achieve higher growth, then that entire curve is going to shift upward and to the left. If we achieve lower growth is just going to slope out the other way, down and to the right. But whichever way it goes, whether you achieve higher growth or lower growth, we're still maintaining the lowest possible corridor of insurance that we possibly can. The main difference between an indexed universal life and a whole life is not what the insurance company is doing with the money. Both types of companies or both types of policies invest in the same exact asset classes. And in previous videos, I've literally showed you the results from the annual reports that show that the insurance companies are investing in the same exact asset classes. The primary difference is that the whole life company is going to take that interest income that they earn on their general fund and they're going to credit it to your cash value as a dividend. In the case of an indexed universal life, they're going to take that interest income and they're going to go out to the index options markets with the goal of buying as much, with the goal of hedging to buy as much movement in the market as they can get with the money that they have to spend. And that's why on an indexed universal life, you see things like a cap and a floor. The cap represents the highest or most movement that they could capture with the money that they had. And since they're investing in options, if the markets go down, the value of the options simply go to zero and you lost the money that you would have received had they paid a dividend. So from a risk perspective, you've still got the same principal protection. You're not losing any principal. The only thing you're introducing into the mix with an indexed universal life is that you've got variable returns from year to year. If the markets go down, you have the opportunity to earn zero. But if the markets go up, you can earn a premium over what you would have received had you received a dividend. So it's important to understand that the goal of an indexed universal life is not to capture the equity market rate of return. There's a lot of confusion out there. The goal of an indexed universal life is simply to capture a premium over what they would have paid had they paid a dividend. The graph that I have up on screen right now is a tool that I like to use for illustrating what the cap rates look like if we apply them to historical numbers. So over the last 5-10 years, we've seen a downward trend in interest rates. And since insurance companies are investing in the bond markets, their returns are also going down. And in the case of that indexed universal life, where the insurance company is taking that interest income and going over to the index options markets to hedge, the pool of money or bucket of money that they have to spend, their budget, has been reduced. So they can't capture as much movement in the market index as they used to. So what we're seeing is lower and lower cap rates on indexed universal life. So what this table does is allows me to plug in the current cap and look at the year-to-year changes in the S&P 500 index for the last 30 years. So the leftmost column here, it has the year 1990 through 2019. In the next column to the right, I've got the actual change in the index from year to year. And then in the third column from the left, or from the right, I suppose, is the look back. So if we would apply the current cap rate, which I've got 9% as an input variable up in the upper left, if you apply that 9% and say, if the market went up over 9%, then we get 9%. If the market goes down below zero, we get zero. But anywhere in between, we get whatever the market gets. So we're just projecting what the IUL would have earned during those historical years. But to calculate the annualized rate of return, we need to compare how we would get from A to B. So I'm looking at the growth of $100 starting from the beginning and going all the way through those 30 years. So by comparing any 2 points on there, actually, if we go to the bottom and look at the 2019 annualized returns, I've got 5, 10, 15, 20, 25, and 30-year periods there. And just for like the 5-year, for example, what we're doing is we're comparing the 2019 value. In the case of the IUL, we've got our $100 investment initially, after 30 years would have turned into $543. If we go back 5 years to 2015, we had $419 at that time. So it's very easy to, actually I shouldn't say it's easy, but I do have a blog post on my website, and I'll put a link to it in the description. It's the formula for calculating an annualized rate of return. But basically you just need to compare the ending number, the beginning number, and figure out that rate of return that would have gotten you from A to B. So it's not an average, it's an annualized rate of return. Here we have year-to-year fluctuations in the market. Some years are down, some years are up. But what I want to know is what is that rate of return that would have gotten us from point A to point B on an even basis. So why am I showing you this? The key takeaway that I want you to get from this is right now, today, the Moody's Corporate Bond Index yield for AAA bonds is 2.43%. And that's what insurance companies are making on any new money that they put into their general fund. I mean, keep in mind, they've got whole bond holdings, treasuries, bonds, munis. They buy tons of mortgages off the banks. So they've got older holdings that have higher interest rates if they haven't been refinanced by now. So they can afford to pay dividends that are still higher than the current Moody's corporate bond yield. But that's being diluted because all the new money that's going into the policy is earning 2.43%, assuming that it's AAA rated bonds. So what you can see here is even with 2.43% or whatever the insurance company is actually making on their money today, the IUL, had we taken a 9% cap and looked back over the last 30 years or last 5 years, we can see that the returns are in the 5 to 6% range. So that's a considerable premium. I mean, 2.5% over what the current Moody's Corporate Bond Index yield is. And that's the power of an indexed universal life. Even if it's not the full 2.5%, as long as you're getting any better return by utilizing an IUL than you would have using a whole life, it's going to make a big difference when you're looking out over 10, 15, 20, 30 years. All right, so wrapping up, there are 3 key success factors for the double play. You want to use a maximum overfunded policy design. You want to have as many of your dollars working in 2 places as you can possibly get. Secondly, you want to use a cash value line of credit so that your interest is tax deductible. The tax advantage is substantial. And lastly, given a choice between whole life and indexed universal life, you really want to use an indexed universal life because it gives your cash value the best opportunity to capture a higher rate of return over time. And if there's one thing that I'm trying to get across in all my videos is I'm showing you facts and data, real numbers that you can use for your analysis. You're not going to find hype and BS on my website. So as you're out there doing your research and you're learning about this from other people's websites, are they giving you numbers and facts, or are they using fluffy terms, talking about guarantees and paid up additions riders and things that don't really manifest themselves in the numbers? Life insurance policies aren't going to earn the guaranteed rate of return. They're going to earn something much greater than that. That may make you feel better, but it has nothing to do with this business model. All right. Secondly, just because your videos have more views and are more well produced than mine, which isn't hard, it doesn't mean that you're providing better information. I hope that in the process of watching my videos that you are getting the information that you need to make an informed decision, that you can do all the homework you ever need to do before you even pick up the phone and call a life insurance agent. Because you need to know what he's going to say and be able to debunk it. And lastly, just, show me where I'm wrong. If you're looking at my numbers and you think that I'm wrong somewhere, let me know. I mean, I'm making my models as simplified as I can So it's very easy for you to show a model that has depreciation calculations in it. I get that. I'm trying to make these as simple as I possibly can, and we can model every scenario out there. So I think you're unlikely to find a business case, whether you're looking at depreciation or anything, where this doesn't make sense. And again, the only times it doesn't make sense is when you can't get that tax advantage or your policy is not designed properly. So that's all I've got for you. If you're hungry for more information, please check out Facebook. I've got the Double Play group. If you want to get more information, you don't want to talk to a life insurance agent, join that group. There are people on there who are doing this. There are people on there who are just like you, they're learning about this. But it's a forum where you can bounce ideas off of other people, a community of like-minded people who are doing this, and learn without ever having to talk to an agent. Really, the only thing you need an agent for is just to finally get that illustration. Of course, there's my YouTube channel. My website is a no fluff zone, so there's a treasure trove of information there. It's not a lot of pretty pictures and fluff. It's real good information that you can use. Blog posts that mirror a lot of the content that I've covered in these YouTube videos. I do a weekly, or actually bi-weekly now, webinar every 2 weeks where I present these topics, and those are the topics that end up getting turned into YouTube videos eventually. So if you liked this video and you want to see more, be sure to subscribe to this channel so you're notified whenever I put new videos out. Give this a like if you enjoyed it. Please share it with your friends, anybody who you know is interested in this. And I look forward to seeing you in the next video. Thanks for watching.